Welcome to your Profitable Law Firm podcast. I'm Kelly Brubaker, your dedicated host, passionate about empowering law firm owners. Let's dive into the hidden strategies that lead to overflowing profits, scaled growth, and thriving lives. This is where overwhelm transforms into confidence, enabling you to create and enjoy your dream firm and your dream life. How does free CLE sound? Please join me at the virtual legal seminar hosted by LawPay, MyCase, DocketWise, and CasePeer. I'll be one of the guest speakers at this half-day virtual event. It's being held on October 1st, and I'll leave a link to register in the show notes below. So today we're diving into a paradox that puzzles many law firm owners. How can your business show a healthy net income, yet struggle with cash flow? So let's start with a scenario that you might relate to. Your latest P&L shows a respectable net income, but your bank account is running on fumes and you're stressed about making payroll. So how is this possible? The answer lies in understanding the difference between profitability and cash flow. So what's causing your money problems? Well, simply put, it's the timing. Money's slow to come into your firm, but it's very quick to leave. So here's some examples. Delayed client payments. So law firms historically have billed clients once a month for services rendered. And this creates a scenario where the work you have completed in the first week of the month will not be paid for a minimum of 4 weeks, but realistically more like 5 to 6 weeks. And that's if your billing's completed in the first week of the next month and your clients are fast to pay upon receipt. There's also your WIP, your work in progress. So unbilled work represents future revenue, but you still have current expenses. You will have to pay client costs in advance to the extent that your clients have not yet provided you retainer for their casework. Plus, you're paying your payroll costs now in real time, but not receiving the cash on their work until later. And then there's your operating expenses. Rent, salaries, software subscriptions all need to be paid regularly. These create a steady cash outflow regardless of your cash inflow situation. Owner and partner distributions. So distributions to the firm owners are not reported on your P&L. So if you take $100 in distributions or $100,000, the net income on your P&L is not going to change. So be careful with distributions because if done without planning, they can deplete cash reserves and leave the firm cash poor despite being profitable. And then there's firm debt. Firm debt has a similar impact as owner and partner distributions. Let's say you have a monthly loan payment of $1,000. That payment's really two things that you're paying for. You're paying interest to the lender and you're paying back some of the principal. The interest piece will be reported on your P&L, but the principal part is reported on your balance sheet. So what are the solutions to bridge this gap? Now that we've talked about what's creating these issues in your firm, let's talk about how to better manage your cash flow. So let's enhance your billing practices. Here's some things that you can do. Increase the frequency of your billings process. Now, I know you won't be able to bill for contingent cases until they're settled. That's a given. But for flat fee work, require at least 50% of the bill be paid prior to the work being started, with the balance due upon delivery. And for hourly work, try billing every week or every other week instead of once a month. If this change makes you feel uncomfortable, I ask that you at least try it with this modification. Perform the billing process every week, but only bill the matters that were closed in the last week. I'll take baby steps wherever I can get them. No matter what billing system you use, you can't bill the same ticket twice. And a bonus here is when you bill weekly, you're forced to have all your time tickets entered weekly. Capturing time tickets in real time will improve the accuracy in comparison to capturing time tickets and billing done on a monthly basis. Be sure to include a specific date on your bill. Do not use the phrase due upon receipt, which can give an excuse to the client to wait to pay it. And lastly, define your firm's follow-up procedures for unpaid bills. What I mean here is to set up automated reminders for unpaid bills if your billing system has this feature. Have the billing system send a reminder every 7 to 10 days. Be sure to include tasks such as phone calls and mailed letters the longer a bill goes unpaid. Unless the client is a one person operation, contact should be made to different people for a status on the payment. Now, this is something that I think established firms are good at, but maybe a newer firm hasn't yet thought of. Consider requiring retainers. For litigation, request retainers covering estimated fees for the next 60 to 90 days. For transactional work, set up milestone payments tied to specific deliverables. Here's another idea. Start accepting credit card payments from clients. I know traditionally the legal industry has been entrenched in receiving checks from clients. Yes, accepting credit cards costs money, typically 3 to 5% of the transaction amount. But if you use a processor that is integrated into your billing system, accepting credit card payments online will actually reduce the time needed to post payments to the client's account. Raise your rates across the board by 5% to cover the merchant fees. Accepting credit cards will help you get paid faster, so it will alleviate time wasted on collection of aging unpaid bills. So let's talk about managing your WIP. Regularly convert WIP into invoices. Implement biweekly WIP reviews to identify billable work. Require your staff to submit time entries daily or weekly at the latest. Monitor and manage the growth of unbilled work. Set WIP thresholds for each matter. Alert partners when those limits have been exceeded. Use visual dashboards to track WIP across the firm. Let's talk about cash flow forecasting. Develop a rolling 13-week cash flow forecast. Use historical data and known upcoming expenses to project cash needs. Update weekly, comparing projections to actuals to improve the accuracy. Use this to anticipate and prepare for cash crunches. Identify potential shortfalls 4 to 6 weeks in advance. Develop action plans for different scenarios. Like, do you need to accelerate collections or defer payment on expenses? Have you thought about managing your credit line? So, establishing a line of credit for working capital needs. Negotiate terms with multiple banks to find the best rates and conditions. Consider asset-based lending using accounts receivable as collateral. Use it judiciously to smooth out cash flow fluctuations. Draw on the line to cover short-term gaps, not long-term deficits. Repay quickly when cash flow improves to minimize interest expenses. Align partner compensation. By this, I mean tie partner draws more closely to cash collections, not just the paper profit. Implement a base draw plus bonus structure based on collections by partner. Use a lockbox approach. Allocate a percentage of collections to partner compensation. Let's see how taking an active role in managing your firm's cash flow can look. Here's a case study from a firm where I've changed the name for privacy reasons. We'll call this firm Smith & Jones Law Firm. So here's some background on this firm. They have 2 partners and 3 associates. They specialize in corporate, IP, and employment law. Their annual revenue is about $1.6 million with net income around $235,000. So here's the problem. Despite showing a healthy profit, Smith & Jones found itself consistently short on cash. The partners were getting frustrated that their distributions were sporadic and the amounts fluctuated, and the firm had to dip into its line of credit to make payroll several times throughout the year. So what was going on? What are the root causes going on here? So we realized that there were 3 big problems. First was delayed payments. The firm's largest client, which represented about 50% of the firm's revenue, consistently paid their invoices 60 to 90 days after receipt. The second problem was their WIP. Though not part of their wheelhouse, the firm had taken on some litigation cases, which was leading to large WIP balances. And the partner draws. So monthly partner draws were based on projected annual profits, not actual cash collections. So what were our solutions? We worked on billing practices. We negotiated new payment terms with their largest client, offering a 2% discount for payments made within 30 days. We implemented milestone billing for litigation cases with 25% due at filing, 50% due at discovery completion, and 25% due at trial or settlement. We worked on WIP management. We instituted a biweekly WIP review for all cases over 25,000. We implemented a policy to bill at least 50% of WIP on large cases every other week. Implemented a KPI dashboard. Smith & Jones brought me on board as their fractional CFO to develop and maintain their KPI dashboard. By focusing on specific numbers that aligned to their goals, they knew at one glance if they were on or off target to meeting their goals. We discussed monthly what changes were working so they knew to keep those in place, and we worked to tweak what didn't seem to be working to get them back on track. We implemented a cash management system that gave them a plan in advance with how to use all incoming money. It let them set aside small amounts of money every week towards known large expenditures. For example, their annual malpractice insurance premium, hiring a new associate in the future, and year-end bonuses. That way, one large payment didn't create a panic. And we worked to restructure partner compensation to include a base draw, which was 50% of expected compensation. It was paid monthly with quarterly distributions based on actual cash collections. So what happened? Well, the results after 6 months of implementing these changes were the following. First, the firm's average days sales outstanding decreased from 73 to 42 days. WIP balances decreased by 30%. The firm hasn't needed to use its line of credit for working capital in the past quarter, and partner satisfaction improved as distributions became more predictable and aligned with the firm's cash position. I hope you realize this case study shows how understanding and actively managing the relationship between profitability and cash flow can transform a law firm's financial health and operational stability. Remember, profitability is important, but cash is king. By understanding the disconnect between net income and cash flow and implementing strategies to bridge that gap, you can ensure your firm not only looks good on paper, but also maintains the liquidity needed for smooth operations. So I have a question for you. You started your firm with the goal of making money, right? Well, let's make sure you're on the right track. Whether you've just started out or you've been in the game for years, there's always room for improvement. I'm inviting you to join the Your Profitable Law Firm community. This community is designed to help you run your law firm more profitably. Now, we're not reinventing the wheel here. These strategies have been tried and tested by thousands of law firms over decades. So what sets us apart? Well, we break down these proven ideas into practical, actionable steps that you can implement right away. So here's how it works. Each month, we focus on one specific strategy. Think of it as a bite-sized approach to optimizing your business. These are the same types of strategies that high-price management consultants would recommend, but without the hefty invoice. Plus, we'll help you maximize revenue from each client and uncover the not-so-secret key to greater efficiency. Imagine your law firm where profits flow effortlessly, where you're getting the most out of your staff and technology. Whether you want a boutique lifestyle business or you have dreams of scaling up, the choice is yours, so why wait? Let's turn your law firm into a profit powerhouse. I'll leave a link to join in the show notes below. If you have any questions about today's episode, please let me know by commenting below. If you know someone who might need to hear this information, please share this episode with them. Be sure to follow and subscribe to get notifications for future episodes. Did you enjoy this episode? Please consider leaving a review. And before I go, remember, profit is something you intentionally plan for in the beginning. It is not a potential bonus at the end of the year. Thanks and have a great day.